The Federal Open Market Committee of the U.S. Fed announced on Wednesday that it would raise the target range of the federal funds rate by 25 basis points to between 4.75 and 5%, the highest level since October 2007. It marks the ninth consecutive rate increase since March 2022, or the first rate increase after the collapse of California's Silicon Valley Bank has triggered a wave of volatility in the global banking sector. The Silicon Valley Bank, the 16th largest bank in the United States, was closed on March 10th by regulators due to insolvency, according to the U.S. Federal Deposit Insurance Corporation. Noting the climbing U.S. federal debt, McCormack said that the U.S. economy is expected to slip into recession in the second half of this year.
So we should expect interest rates to continue, we think, to rise from here, which is not yet fully resolved, and we don't know the extent of how far that will spread. But that's a different set of policy tools. That might not be interest rates. So government debt in the United States is well over 100% of GDP. We have it at 115% of GDP. The global average is about half of that. Unfortunately, we don't see much of a strategy or a plan from the government to address its very high debt levels. Even using the government's own forecasts, the debt to GDP ratio will continue to rise for the next 10 years. We think there will be a recession in the US in the second half of this year. This was before there was any turmoil in the banking system. So that was just based largely on higher interest rates. And as the Fed continues to raise rates, that has an effect on the economy.
Despite the recent banking sector crisis, the Fed has signaled that its battle against persistent levels of inflation must go on. The committee reiterated that it remains highly attentive to inflation risks. I expect interest rates that banks pay depositors are likely to have to go up, while government bond rates will fall as depositors become more aware of their available rates and risk options. This could place some downside pressure on banks' net interest margins that could drive more consolidation within the industry and less credit expansion in the economy.
Global market strategist for Asia Pacific, David Chow, predicts that the negative spillover effects of the U.S. banking turmoil will impact the European banking sector and the European economy.